This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
All right, everybody, as we mentioned, it is about Halloween and higher candy costs, but it's also a very eventful week for financial markets here in the U.S. We've been talking about it, more earnings, got a big one from Apple. We've got a monthly jobs report on Friday. And of course, we have a really, really big one, Tim, and that is the FOMC meeting on Wednesday.
Yet. As Bloomberg News Chief Correspondent for Global Macro Markets, Liz McCormick, writes in a most read story on the Bloomberg today, the Fed's policy statement is setting up to be the number 2 event on Wednesday. Investor focus, Carol, instead is likely to be on the Treasury Department's new borrowing plan that's due hours ahead of the interest rate decision.
Right. We just already got a glimpse of a little bit of that. Liz, of course, joining us here in our Bloomberg Interactive Broker studio. So glad you're here in studio. We just got a headline, and it looks like the U.S. Treasury actually doesn't need as much money. Good thing. It still seems like a lot of money, but go ahead.
Many hundreds of billions
yes.
still. And by the way, it's cool to have Treasury Department sexy again, right? You know, it's not all the
Don't go that far.
I don't want to go that far. But yeah, so, like to explain, because sometimes it gets confusing. Today they give out like the estimates in aggregate for the whole quarter, right? Okay. Not like, hey, we're going to sell this much of 10-year notes and this much of 30 years. But you're right, they did shave it down a little bit, $76 billion, relative to they had a first estimate a few months ago. They said, Treasury officials kind of gave us some guidance that part of this is related to, the natural disasters in California, and some of those other states delayed some of the tax receipts that came in. So that's part of why they end up having like a little bit higher revenues that made them lower this down a little. On net, there's still a lot of borrowing to come. They even said this for that quarter in any year is a record. Last quarter, we had a record over $1 trillion for that quarter. So still all eyes will be on Wednesday when we get what we call the refunding, where the Treasury will say, hey, next week we're going to sell X billion of all these different securities to fund the deficit and other things over the quarter. And so that's kind of more the granular, what people who trade bonds want to know. They're going to lean heavier to the long end or the short end and that kind of thing.
So why is that so much more important than what we hear from Jay Powell?
Well, so I tried to put in the story. I think it's kind of there that Jay also and co kind of set up this meeting as like Subhadra Rajapapa at SocGen said, kind of a placeholder. Kind of gave us a lot of signals that they're going to maybe take a pause, take a beat. And they said the rise in yields have done part of their work. So, the bond market is really, like swaps traders, really priced out the odds of any hike. So, and we don't have the dot plot this time. It's not one of those dot plot meetings, right?
You almost feel like Jay in the press release is going to be like, guys, got nothing. We'll see in a month or two, right?
Pay attention to the Treasury, not me.
Can I just skip it? But explain, though, why it's so important, Liz, to understand what's in that refunding and the details. And we keep talking about, right, the longer end, there hasn't been so much interest, right, in auctions because investors, in terms of higher yields, explain it for me.
Yeah, so
because you're smarter than me on
there's
this.
a lot of reasons, but they've had to. Let's say the U.S. Treasury sells a lot of paper. They always sell it, no problem. But they might have to pay up, right? So yields have been going up more so on the long end. A mix of things. First of all, the Fed higher for longer has settled in. That kind of bring rates across the curve higher. Some people feeling like we're going to have a stickier inflation, like maybe not get to 2, but stay around 3. So that higher, let's go wonky. R-star, Fed's long run rate may have to be higher too. And then let's get to the Treasury stuff. A lot of supply, deficits, Fed's not in the buying game anymore.
Right.
So that's a lot of supply. Some of the buyers that used to kind of suck this up easily are not there as much.
Yeah, I wanted to talk about that a little bit. Who are the buyers who are not showing up? And is there any indication they're not going to be showing up on Wednesday?
Yeah, so let's just say, because someone will yell at me if I don't, people are always kind of somewhat involved. The dealers have to participate in auctions, but let's look at commercial banks who we know are not buying treasuries. They're having a lot of trouble with they're selling treasuries because all the issues on their balance sheet with some of the other banks. Foreign central banks haven't been as active for a long time. They don't need it. The hedging costs are higher. Plus, we got the BOJ Tuesday, right? There's been this ongoing speculation that maybe let's just forget what happens Tuesday at the BOJ meeting, but that, rates abroad may be getting more attractive. If the Bank of Japan finally lets go of yield curve control, Treasury's not the only game in town, right?
Tim and I caught up with Kathy Jones of Schwab last week. Great conversation. People have tweeted on it and said and I wrote the notes down. She said she's tried for years and for decades actually, to find a relationship between Treasury supply and interest rates. And she goes, I'm not able to find any kind of solid correlation. Is that why we care about this refunding? Is it the amount? Is it the composition? What's the takeaway for our audience?
Yeah, so, I don't know if everyone can see, but I brought my paper. This is like the last refunding. They give you a little
Treasuries
table.
are tough.
Treasury, me and my folks, we do it to write this report. So they say each maturity, this is what we're going to sell. The auction's going to go up at $2 billion, $1 billion. So all the traders who trade across the curve, so if Treasury, like last time, they increased 10-year notes by $3 billion for the new issue.
Right.
Say they go 1. Oh, maybe Treasury 10 years look a little better than 5 years. So that's why the real traders are looking, where do they put it? Because what's known, sadly, is that they're going to increase. We have a deficit that's very large.
Yeah.
Like we said, the Fed's doing QT. That's known they have to increase. Just where they do it, or do they sell more Treasury bills, which Alex Harris has a great story out today on bills, so many bills, so...
We're going to come to you for a post once we get the news. Liz McCormick, thank you so much. It's complicated, Treasuries, and she always makes it so simple. Chief Correspondent for Global Macro Markets, of course, here in our studio. Also in our studio is Bloomberg News personal finance reporter Claire Ballentine, also recently involved in assessing another measure of wealth, specifically Taylor Swift's, which we loved. But speaking of the Fed, another one of our most read stories, just like Liz's, is about the Fed's fight against inflation and what it is doing, Tim, to middle-class Americans.
Yeah, Claire Ballentine joins us now. Claire, good to have you with us. This is part of a series that the Harris poll did with Bloomberg News. And I was struck by this story because it got some exclusive data about the way that inflation is hitting the middle class. Talk to us about the findings.
Yeah, so it's been really great to have this survey because we've been doing it for a year now, and we've periodically, every few months, ask the same questions until we can compare how things have changed. And so in this most recent one, we found that 44% of middle-class Americans said they were stressed about the economy, which is up from 40% a year ago and 39% in March. And that might not seem like a ton, but it really is ticking up, and it's a significant portion of regular Americans that are concerned about what's going on.
Go ahead. Well, what's interesting? Go ahead, Carol.
No, it's a trend line. I feel like we keep hearing from people. I had a conversation with a prominent CEO this morning, and just like, what the heck is going on? That it just feels like, higher costs are very, very sticky.
But some of this is about perception, Claire, more so than the actual numbers. Because if you look at the numbers, inflation is increasing at a rate that's lower today than it was a year ago. So I'm wondering, kind of how we explain that.
Yeah, so I would say that is a great point. What the data shows is that inflation is slowing down. For the average person, though, the perception, they aren't looking at the CPI numbers month after month like we are. What they see is that, they go to the grocery store and things are more expensive. And a big part of that also is that their wages aren't keeping up with that. And so, even though the problem is getting better thanks to the Federal Reserve's rate hikes, most regular households are worried about that. And on top of that, they're feeling the impact of higher borrowing costs. I talked to people that were wanting to buy new cars, or, they had more money on credit cards, and the rates are just going up is hurting them.
Okay. I feel like, though, this is so indicative of our environment. While stress was easily the most, I guess, that a lot of people were feeling, right? Their emotions, they were stressed. Because of paying more, and they still feel like inflation is impacting them. There was also a jump from a year ago in the share that said that they were optimistic. So, help me. I don't understand that.
It's really complicated. And I think what, you all are getting at is that these are people's feelings and their perceptions. Some of this breaks down across party lines, where Republicans feel less confident about the economy. Democrats are feeling more confident about it. So it really is an issue of perception. I think sort of the takeaway is that, all these people are hanging in there. Are any of these people happy about the economy or think things are going to improve? No. And that has big implications for how they spend.
Right.
And
absolutely
what they do.
Huge political implications, too. I mean, we've talked about other polling that Bloomberg has done that talks about how, former President Trump is leading President Biden on economic issues in 7 key battleground states. It's about how people feel about the economy.
I love this one quote. The good news is about this is one individual. It says the good news is he got promoted. The bad news is he got relocated with a higher mortgage rate, right? Like, so it's like people are working, or if they move for a job, but it's a place where they have to buy a new home, that costs them a lot of money.
It's a double-edged sword. It's like no matter what they do, they're either getting hit with inflation costs or with borrowing costs right now.
Liz, it's just, if we get the quarterly refunding, it's all going to be fixed, right?
Exactly. Yeah.
That's a no.
I just want to fix my deck and the HELOC. It's too expensive.
Yeah, not going to happen for a while.
That is so true. That is so true. It's really preventing people from spending. See, this is it. Sentiment or reality. Claire Ballentine, thank you so much. Personal finance reporter at Bloomberg News in our studio, of course, with Liz McCormick, as we said, Bloomberg News Chief Correspondent for Global Macro Markets. 2 of the most read stories on the Bloomberg. Check it out on the terminal and at Bloomberg.com. This is Bloomberg Radio.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
Well, shares of Hertz closing at a record low today. This after the company last week missed earnings estimates amid Tesla price cuts and then the high price of repairs for those EVs. Really eager to hear from our next guest about all things when it comes to the car rental industry here in the U.S. and around the world. Chrissy Taylor is president and CEO of Enterprise Mobility. It's the company, Carol, that until recently was known as Enterprise Holdings.
That's right. They own National Car Rental in Alamo. Chrissy, by the way, the 3rd generation of the Taylor family to run Enterprise. Her grandfather, Jack Taylor, founded Enterprise back in 1957, and his son, Andrew, was CEO before Chrissy. So it really is a family-run business. Enterprise, by the way, has a fleet of 2.3 million vehicles and 90,000 employees around the world. And we are so delighted to have Chrissy here in our Bloomberg Interactive Broker studio. Welcome, welcome, welcome. How are you?
Thank you so much. I'm great. Thank you so much for having us. And we're excited about this announcement. Once Enterprise Holdings and now Enterprise Mobility.
Why the change?
Yeah, we have been Enterprise really has been moving mobility forward for 65 years. And we are excited because all of our business lines, like daily rental, are gigantic and are a huge opportunity for us. And so over 65 years, we have evolved in terms of geography, customer segments, and products and services that we offer. And so when my grandfather founded Enterprise as a leasing company, we're now known as the world's largest rental car company. We have car sales, a retail car sale operation. We've got car sharing, we've got van pooling and commuting. We've got a truck rental business. We have global operations. We have hourly, we have luxury. We have a variety of technology solutions with partners. And so Enterprise Mobility better fully represent who we are and what we do today.
I don't hear drones. Are there going to be drones?
There aren't drones, but we are definitely leaning into the future about what's next.
So you're a private company, so we don't get a good look every quarter, under the hood, so to speak, of the company. But if you think about the whole pie, what portion of that is daily rental versus everything else you just mentioned? Because I think it's fair to say a lot of consumers know Enterprise for its core business.
They do. The world knows us as rental car, and it is a majority of our business today. However, the original business that my grandfather founded, which is today Enterprise Fleet Management, has 675,000 vehicles, where daily rental in North America has 1.2 million vehicles. So fleet is half the size of our rental business. We've got 90,000 vehicles in our truck rental operation. And we continue to grow our footprint with retail car sales with over 150 dealership locations. So when we look across the Enterprise Mobility portfolio, there is a ton of opportunity, not just in rental. We love rental, but we are way more than a rental car company. And when we look at the future in growth, it really is in a lot of these other business lines where our people have opportunities to develop careers and stay with us for the long haul. It's great.
Well, what is the most profitable part of your business?
So when we look across our entire business, all of our businesses contribute to the bottom line and revenue. And so we had a phenomenal fiscal year, a record-breaking fiscal year. And so we measure that in terms of employee engagement has never been higher. Customer satisfaction around the globe has never been better. And those two things drive business results. We look at our international...
Don't you think the economy also drives business?
Absolutely. So the traveler is back on.
Yeah.
No question. Sorry, I didn't mean to cut you off.
No. Go. But Tim and I were talking and kind of getting ready. Like, we love companies like this because it does give you a great snapshot of the economy at a time when we feel like, Chrissy, we get such mixed data points from day to day, week to week?
Mm-hmm. So the traveler is back on, and we see that at the airport, and they want to travel. The business traveler is back. Only 30% when we talk about our daily rental business happens at the airport. 70% of our business happens in our suburban market.
Who are the people who are renting in suburban markets?
We do have leisure customers, so when somebody's going away for Thanksgiving, they might drive from St. Louis to Chicago, but a majority of that business is long-term contracted business. So Bloomberg, when you're traveling for business,
right,
you go rent a car.
Right.
We have many of those business customers that rent in the home city. And then we also have a large part of our business. If you unfortunately get in an accident, your insurance company will refer you as the rental, as we are the replacement vehicle. And so it's long-term contracted business that we are helping the communities move.
Let's talk EVs. How do EVs fit into the future of mobility?
So we absolutely embrace the responsibility and the opportunity to transition our fleet. And we want to make sure we take a long-term perspective on that and strategic look and put the customer at the center of everything that we do. There are three things when we talk about electrification. One, customer experience. We want to make a positive difference in that experience for the customer because it is new technology and they don't understand. Most people don't understand charging. The second thing we focus on is power in our communities and infrastructure. So where are you charging in all of our local communities? And then we want to make sure that that charging, it's equitable and accessible because we have 9,500 locations, not just at airport, but in a variety of communities that people need access. And so for us, it's not about the numbers we're putting in. Yes, we've got electric vehicles in our fleet, but it is about making sure the customer has a great experience and we are a trusted, valued partner in that transition.
Are you slowing, though, the purchase of EVs? And we're asking because it does feel like there's some momentum behind kind of a slowdown.
And Hertz talked about it just last week.
Consumers, yeah.
We have thousands of vehicles in EVs in our fleet, both in Europe and in the US, and our buy is a continuous buy, and so we will continue to add EVs, but it will be at the pace of our consumer. And also our fleet management business, it's really important. It's not just about adding vehicles into our rental fleet. Our fleet management business, we help small to medium-sized businesses with their goals. Domino's Pizza is a great example. They are an awesome partner and they are electrifying their delivery fleet. We are the fleet management company behind that, and we are a trusted advisor, and we love to play that backseat role to help Domino's achieve their goal of delivery, which is great. So it's about buying EVs, but it's also about being a partner and a trusted advisor.
Well, how many EVs do you guys have in the traditional rental car fleet right now?
So we have thousands. So we have probably about 5,000 vehicles in traditional rental, and we will put them we put most of them in our suburban market where people live and work.
And do you see that number growing? How do you see that number growing over the next few years?
As our fleet grows and as the customer demand grows, we will continue to add those vehicles into our fleet. It's just like a suburban.
Are you thinking twice about it, though, after what we saw from Hertz, where they're saying, okay, the value of Teslas have gone down, so that's hurt us as a business. And then the repair costs are more expensive than we thought. Does that make you think differently?
So when the customer demand, we will continue to move at the pace of the customer.
No, we get so I guess what we're trying to figure out is like, are consumers demanding them less?
The consumers, the demand for consumers and EVs is very low right now. That is why it is important that customer experience is on point. So we have thousands of them. We do transactions. People do ask for EVs.
Right.
But it's not to the point where someone is asking. The difference would be, or this example would be, a suburban rental over the holidays. We know everyone wants minivans and Suburbans. They're loading up the cars.
Right.
They're going on holiday. Some people want an EV. That's not to the point at where we're at. And so fleet plans are very, very important in our business. We look at it every single day. We want to make sure that we have
She's like, I look at the numbers.
I look at the numbers. We want to make sure that our fleet is diverse and represents consumer demand, so that we can meet their expectations and provide a great experience. And we have a huge role to play in that. So we need to be on point when we're renting an EV. It's not only just it's electrified.
Right.
These cars, have you all driven an EV?
Yeah.
Their technology is, this is a technical term.
Yeah, I don't know if I
it's
want
off
some
the hook.
random
it's very
person
different.
getting in and driving it for the first time as a rental.
It is very complicated, and the average age of a vehicle
They're
on
fast.
the road is 11 years. They are fast. There's a lot of technology in it, and it's electric. And so we need to be very mindful and thoughtful of what is the customer experience. So I know I'm a broken record, but it is really important that that customer experience is high and we do the right thing by the customer.
Top of mind when you look at the next 6 to 12 months, does recession ever come into your mind right now?
We are very optimistic. We do not see travel slowing down right now. And in all of our business lines, with truck rental is a good indicator of the holidays because they're last mile. They're delivering products and services that are coming for the holidays. And that business is doing very, very well. And we see a strong holiday. Daily rental, we see a strong holiday. And throughout the beginning of next year. So we are very optimistic about the next 12 months.
Cool.
Come back. This was really fun.
Yeah, come hang out with us again.
I was like, we're done?
We could talk so much more. It's like such a fascinating space, and between cars, consumers, it's a lot of stuff. But we've got to do some news. Will you come back soon?
Yes, thank you very much.
Don't jump yet. We're so delighted. Chrissy Taylor, she's President and Chief Executive Officer of Enterprise Mobility, joining us here in our Interactive Broker Studio.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, TikTok, everybody. Just under 18 minutes left in today's trading session. Carol Massar, along with Tim Stenovec, live in our Bloomberg Interactive Broker Studio on YouTube and, of course, on Bloomberg Originals. And as you heard from Charlie and Bill, stocks just rolling over their best levels of the session. But you're talking about 1.25% higher on both the S&P and the NASDAQ. This is after the S&P technically had a correction, 10% off of those July highs. We saw that on Friday, but very different tone today, and the Dow's up 1.7%.
And what are yields doing, Carol?
And what are yields? Aren't they backing off a little bit?
They're higher.
They're higher.
Yeah, so I don't get it.
Yeah, but they're off their highs of the session, too.
Yeah, but the 10-year's, still at 4.88?
Right, but it was at 4.9 or almost 4.9 earlier today.
Okay.
Yeah, I'm just saying.
Okay,
Perspective
that's fair.
What is it?
When in doubt, zoom out. Hey, I'm really curious what Max Wasserman has to say about all this. Founder and senior portfolio manager at the independent investment firm based in Illinois, Miramar Capital. Max on Zoom from Northbrook, Illinois. Max, good to have you with us. Where are we in the cycle right now? I'm having a hard time understanding it.
Well, thank you for having me on. I think today is more of a relief rally because the market sold off a little bit, and you're seeing some people guess about what the Fed's going to do and if they stay pat. And you're also thinking that the excursion in the Middle East is not flaring up as dramatically as people thought it might have over the weekend. So I think today is just a reaction to the fact that you have not as much instability, which is why oil is down, while interest rates are back up. And I think people are wondering what the Fed's going to do, but they're not anticipating a rate hike at this point.
Yeah, I was going to say, what are people wondering then if there's not going to be? We know that nobody's wondering if there's going to be a rate hike at the next meeting. What are they wondering about December?
I think it's more of just like, can they get inflation under control and can we be past the tightening cycle? Because as soon as you're past the tightening cycle, people are going to start looking for a rate cut. I think they're going to be a little bit overly optimistic on that. And we're going to have to see what the inflation numbers look like and what the Fed's appetite is.
Yeah, it's kind of interesting, and I think we all have to be like, whoa, slow your roll here in terms of cutting rates, right? Like we've been fooled before on market expectations of a rate cut, only to see that it's kind of being pushed out further and further. Having said that, Max, one thing I really wanted to get into is you have some specific names that are on your radar. Chevron among them. It's down about 19% year to date. We know big news just as of late. Buying Hess, it's a $53 billion deal. You like it now more than before it bought Hess?
Well, I like it long term. Again, we're a dividend growth shop, so we like the financials. Also, it's a leverage to energy prices. So the deal with Hess will give them better production and give them a little bit more diversification outside the Permian. So yes, I do like it at the pullback. They have plenty of cash, and it was a messy quarter of earnings. There are some issues with cost in Kazakhstan there. But this is a great company. Financials are strong. They're a little bit more leveraged to oil. So a slowdown in the economy will keep oil prices down. On the other hand, if you have a tick up in problems in the Middle East, better production growth for them, I think Chevron long term, go right back to 180, 190, and at a 4.1% dividend, trade at 10 times earnings, I think it's a great place to be.
But you really like the dividend.
I like the dividend. I like the fact that they have a tremendous balance sheet.
Okay.
They've really, they have less debt than like 15% on the books. Tremendous cash production, great operators. So if you look at it long term, we like the energy sector, and this would be one of the ones we have.
Okay, let's go from energy to snacks. PepsiCo, the Ozempic
That's a
threat.
rough segue.
I mean, maybe Pepsi can give you energy. Mountain Dew, I don't know. There's some stuff I could do there, Carol.
Yeah.
We've been talking a lot about this, especially today when you saw Truist get concerned about Krispy Kreme donuts over the Ozempic threat. Are investors, analysts, are they putting too much stock in Ozempic and what's going to happen?
I believe they are. I mean, if you think about it, even if the maximum amount of people are using it, which they say is maybe 5% of the population, you got to think about it, it's still like $900 a month to get Ozempic. It's a very expensive drug, and it doesn't stop you from eating. It just reduces the amount. Now, Pepsi, the one where we have a large investment is, we look at it as like 22% of the global snack business, which is over $200 billion, has 40% of North American beverages. Everybody's thinking nobody's going to eat anymore. Nobody's going to snack as much. And we think it's definitely a hype, if you will, that this drug is going to stop people from snacking and drinking. It may moderate for a small percentage of the population that can afford this drug, by the way. It's a very expensive drug. And again, even if the height of it, you're maybe looking at affecting 5% of the U.S. population at this point. So we think it's an overreaction by far.
I will say not expensive if insurance ends up covering it.
At some point, correct. But even if you give it, it reduces your appetite, shrinks your stomach, if you will. But it doesn't mean you don't eat anymore. And it seems like they've punished all these stocks to the point where the people think you're never going to snack again.
I've seen it at work. It cuts people's appetite. Now, you've got to keep taking it, but I also think about for the people who have diabetes, and it's a big part of our population. So I'm just thinking, and we did a story on Madison Muller about how there are lots of other, ailments, if you will, liver, kidneys, heart, that they're now looking that these GLP-1 drugs might be able to be effective in. Alzheimer's, substance abuse. If indeed it becomes this wonder drug that expands out a lot, then what?
Well, I think what you're going to see is, I think most of the markets reflect it. If you look in the medical device segment of the market, companies that we have investment in like Medtronic, Abbott Labs have been hurt because people think you're going to have less procedures because of Ozempic. You're not going to have the heart number of procedures you're going to need. You're not going to have knee replacements because you're not going to have that problem. Your diabetes is going to go down. Again, this is not a pill you take and everything goes away. So yes, it's going to have
not yet.
But normally when you see the hype, and I say the word hype because people are discounting these stocks to tremendously cheap levels to the point where they feel like they're not going to do it anymore. I just think it's an unreasonable expectation. Now, it doesn't mean it's not going to be transformative, but again, it's to the point where, is it going to stop people from having heart procedures? It may limit the numbers. Is it going to have people who's not going to have diabetes? Again, what kind of diabetes? Are you not going to have stents? Are you not going to have, again, so are you not going to eat? Are you going to snack? It's to the point where these companies are trading near their 52-week lows. And even though their cash flows, a lot of these companies are very strong, people are just saying basically, sell the rumor, if you will. So I think people are getting a little bit ahead of themselves. When you have great companies like a Pepsi that we have an investment in, paying you 3%, it's growing, it has organic growth, and it has ability to grow internationally in the snack division. So if you look at it from that perspective, I think there's plenty of opportunity, especially when the stock is trading a 52-week low. And in this market, you have a rolling bear market basically going through every sector except for the top 10 large cap tech stocks.
Max, you're not the only person who thinks this way. I hear Paul Sweeney talk about it all the time.
I know. And I do like a bag of Fritos every once in a while. I'm just
Doritos,
saying.
Fritos.
Healthcare could be disrupted potentially by all of this. Anyway, good stuff. Max Wasserman over at Miramar Capital. Thank you so much. Be well.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 3 to 6 Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.